Hi guys, hope you're good. Welcome back to this YouTube channel Artificial and Facts. Without further ado, let's get started. This time we will discuss about negative externalities. Before going any further, we need to know what an externality is. The linkage of an activity with other activities that are not through a market mechanism is what is called an externality. In general, it can be said that an externality is a side effect of an action of a certain party against another party, both beneficial and detrimental impacts. An externality arises when a person engages in an activity that influences the well-being of a bystander and yet neither pays nor receives any compensation for that effect. If the impact on the bystander is adverse, it is called a negative externality. And if it is beneficial, it is called a positive externality. As I said earlier, there are two types of externalities, namely negative externalities and positive externalities. But in this video, we will only discuss about negative externalities. Negative externalities represent the negative consequences of economic activity to unrelated third parties. I will take the example of cigarettes. Cigarettes are goods that are familiar to many people, ranging from adults to small children who have been introduced to goods called cigarettes. Even though they are only told by parents to buy cigarettes at the stall. Cigarettes are very easy to get, because many are selling them, ranging from small stalls to supermarkets. In Indonesia, the rate of people who smoke or are called smokers reaches 39.9% of the total population. This places Indonesia as the seventh country with the highest number of smokers in the world, as reported by economy.okzone.com. The smoking rate is high, one of which is because some Indonesians believe that this cigarette can relieve stress, increase concentration, reduce anxiety, and increased appetite. Some even think that a smoker is cooler than a non-smoker. 3 million people die prematurely each year due to tobacco consumption. These deaths include 890,000 deaths from secondhand smoke. Let's discuss about negative externality curve. I still use cigarettes as an example. On this curve, we can see that the demand and supply are like goods in general. There is the equilibrium point, namely the equilibrium price and the equilibrium quantity. On the demand line, there is a private value. The meaning of private value is the value obtained by the individual from the demand without regard to the external value or the value obtained from the person affected by this transaction. Then, on the supply line, there are private costs, namely costs that are calculated from suppliers or producers in producing these goods without taking into account external cost. If we explore, cigarettes can have a negative impact or negative externality. Therefore, it is not only private cost that must be considered but also external cost. Therefore, we have to calculate the social cost. How to calculate social cost is private cost plus external cost. What are external costs? External costs are costs that must be incurred to compensate people affected by the negative impact or externality of the product. So, this external cost is the cost incurred by tobacco company to compensate for the negative externalities of their products. So, if we input external cost into the supply will shift to the left. It is a new supply in which there is already a social cost. The price which was initially at point A when added to external cost as compensation for the impact of negative externality. There will be an increase of F. The increase of this magnitude is an illustration of the external cost. If the producer applies the price at point C, the price that changes from point A to point C becomes expensive for consumers. Therefore, consumers will reduce the demand for their goods. The interaction of market bargaining will bring up a new balance at point B. Then a new equilibrium point will appear, namely B. We can see that the price is still increasing. This increase in price we call the optimum price. The optimum price is the price after taking negative externalities into the price. So, they allocate 10,000 as external cost or compensation for people who experience negative externalities from their products. Then, the quantity will decrease to the optimum quantity. Why is the quantity decreasing? Because goods that have negative externalities, their production must be reduced to reduce negative effect produced by these goods. Well, usually this product is taxed, so that the price increases, so this tax is used as a compensation fee for people who are negatively affected. So, goods that have a negative externality supply curve will shift to the left, where the price will increase from 10,000 to 20,000 per product. Then the quantity will be reduced because the goods are considered to have a negative impact in order to reduce the negative impact. Whenever an externality arises that results in an inefficient allocation of resources by the market, the government takes one of two options of action. The first option is to apply policies or command and control policies, or to apply market-based policies. For economists, the second option is preferable, because policies based on a market approach will encourage decision makers in private markets to voluntarily choose to tackle their own problems. The government can also implement policies based on a market approach, which can combine private or private incentives with social efficiency. For example, as mentioned above, the government can internalize externalities by using taxes on activities that generate negative externalities, and conversely provide subsidies for activities that generate positive externalities. A tax that is specifically applied to correct the impact of a negative externality is commonly referred to as a Pigovian tax. Pigovian tax, taking the name of the first economist to formulate and advocate it, namely Arthur Pigo. Pigovian taxes are not the same as other taxes, in that we know that taxes in general distort incentives and push resource allocation away from the social optimum. Taxes generally also cause a standard burden in the form of a decrease in economic welfare, or a decrease in producer surplus and consumer surplus, whose value is greater than the income obtained by the government from the tax. The Pigovian tax is not like that, because this tax is specifically applied to overcome the problems of externalities. Due to the existence of externalities, society must take into account the welfare of other parties. The Pigovian tax is applied to correct incentives in the midst of externalities, so that unlike other taxes, the Pigovian tax actually pushes the allocation of resources closer to the social optimum point. So, apart from providing additional revenue to the government, this Pigovian tax also increases economic efficiency. So, from the examples presented above, we can draw some general conclusions. Namely, the existence of negative externalities in both consumption and production pushes the market to produce production outputs in more quality than socially desirable. In some cases, people can solve the problem of externalities on their own. The cause theorem suggests that the interested parties can bargain among themselves and agree on an efficient solution. Sometimes, however, an efficient outcome cannot be reached. Perhaps because the large number of interested parties makes bargaining difficult. When people cannot solve the problem of externalities privately, the government often steps in. Yet, even with government intervention, society should not abandon market forces entirely. Rather, the government can address the problem by requiring decision makers to bear the full cost of their actions. Okay guys, thank you for watching this video. If you like this channel, please give some like, comment, and subscribe. See you on the next video.